Welcome back to The Explainer. I am absolutely thrilled you're joining us today because, well, we've got an incredibly dense, massive set of data to unpack. We're breaking down HSBC's Q1 2026 earnings release. We're going to look right under the hood of one of the world's largest banks to really understand their current financial health and, honestly, more importantly, their future strategy. We're taking all those dense financial filings, the analyst transcripts, the strategic reports, the whole shebang, and translating them into clear takeaways. So get ready because we're going to see exactly what's driving the numbers at HSBC right now.
Okay, let's dive right into this. We've got a clear, organized roadmap for us today. First, a snapshot of Q1 2026. Then, we'll look at the wealth and revenue drivers. Third, the new cost-cutting drive. Fourth, how they're navigating macro risks. And finally, the strategic horizon.
All right, Section 1, the Q1 2026 snapshot. And let me just build a little anticipation here, because when you actually dig into these Q1 results, you are immediately hit with some numbers that, frankly, we just haven't seen in a very long time.
Boom, 18.7%. This is their return on tangible equity, or ROTE, for the first quarter of 2026, if you exclude notable items. Now, to put this massive number into perspective, management explicitly stated during their investor call that they haven't printed a number this size in nearly 20 years. I mean, that is a 2-decade high for profitability relative to the bank's tangible capital. It's an incredible start to their year, and for sure it sets a very, very high bar for their targets over the next 3 years.
Now, just to make sure we're all on the exact same page, let's briefly clarify what ROTE actually is. Basically, return on average tangible equity measures how much profit a company generates from the physical, measurable capital that's actually owned by the shareholders. It strips out all those fuzzy, intangible items like goodwill or brand value. Think of it kind of like a giant farm, right? It's like judging the farm strictly by its actual crop yield per acre, rather than, factoring in the value of the farm's trademark or logo. It gives us a clear, unclouded picture of how efficiently they're turning real capital into actual returns.
So what's really interesting about the granular proof behind that headline's success is just how big these numbers are. Look at the profit before tax, a staggering $9.37 billion in just one quarter. Profit after tax sat comfortably at nearly $7.4 billion. And this was all driven by a massive revenue engine generating $18.62 billion, which translates to a basic earnings per share of 41 cents. So even with higher credit charges in the quarter, the sheer volume of revenue across all their diversified businesses kept that bottom line incredibly strong.
Section 2, Wealth and Revenue Drivers. That covers the what of Q1, but we really want to know the how. How did they actually pull this off? Let's look at the engines driving this growth.
A key driver here is banking net interest income, or banking NII. Really quickly, this metric adjusts reported NII to account for the impact of funding trading activities and excludes third-party insurance. For Q1, banking NII actually grew by 6% to hit $4 billion. And this wasn't an accident. It was a direct result of really strong financing demand across both developed and emerging markets, and strategically deploying increased funding into trading activities, particularly on higher bullion balances.
But honestly, the real star of the show here might just be the wealth division. In Q1 alone, HSBC pulled in $39 billion in net new money. And here's the absolute most fascinating part of that. Of that $39 billion, only $5 billion sat in deposits. A staggering $34 billion, that is nearly 90% of those flows were actually invested. Analysts at Goldman Sachs even pointed this out during the Q&A, asking, is this a structural change? What it tells us right now is that HSBC has a highly engaged, active client base that's putting their money to work, not just letting it gather dust in cash.
Moving on to Section 3, the cost-cutting drive. Because here's where things get really interesting. Despite these record profits, HSBC is initiating a massive strategic pivot.
Revenues are up, profits are breaking 20-year records, but they're still going under the knife. The landscape of British banking in Asia is shifting, and HSBC isn't the only one trimming down. They're trying to keep pace with rival Standard Chartered. And this brilliantly illustrates the contrast. Both banks have earmarked 2026 as the deadline to cut $1.5 billion in costs. But Standard Chartered started its Fit for Growth plan a year ago with $1.5 billion in upfront costs. HSBC's program, on the other hand, is shorter. It's starting right now, and it's slightly more expensive to implement. They're facing $1.8 billion in severance and upfront costs to achieve that exact same $1.5 billion reduction target.
So you're probably wondering, where exactly are they trimming the fat? Well, they're heavily targeting staff expenses, aiming for an 8% decrease overall. But, and this is absolutely crucial, this is not just some broad bottom-up reduction. The focus is deliberately aimed at more senior roles and specifically streamlining that UK head office. The ultimate goal of all this restructuring? It's to ensure the bank can consistently hit that target of mid-teens return on tangible equity for 2025, 2026, and 2027. They're prioritizing a really lean, efficient operational model over bloated top-line growth.
Now, some analysts do predict this might cause a slight dip in profit in the immediate near term of 2025, but overall, the market consensus is pretty supportive. Michael MacDodd, a senior equity analyst at Morningstar, summed it up perfectly. Given the complexity of HSBC's operations, we think it's prudent for management to focus on medium-term efficiency gains rather than more disruptive overhauls. So basically, it's a measured, calculated approach to efficiency rather than just chaotic, across-the-board slashing.
Section 4, Navigating Macro Risks. Let's pivot our narrative a bit to the global economic horizon.
Because no matter how efficient a bank becomes internally, it still has to operate in a totally unpredictable world. As management noted on their call, it is simply good practice to keep a range of extreme stress scenarios as part of your planning. HSBC models what they call global demand shocks. These are severe downside risks way out in the tail of the distribution, simulating a massive downturn in economic activity that drastically pulls down inflation and forces central banks to slash interest rates. Now, they aren't saying this will happen, but they are rigorously stress-testing their balance sheet against it.
Let's see how this builds into their actual risk modeling across different regions, because the contrast is wild. When applying probability weightings to different scenarios, look at the UK. It gets a 75% weighting on the normal central baseline scenario and a 0% chance on the severe shock. But then, look at the US, Hong Kong, and mainland China. The central consensus drops to 50%, and they assign a distinct 30% probability to that severe downside 1 scenario. So this tells us exactly where HSBC sees the most macroeconomic vulnerability right now, the US and Asian markets.
Which leads us perfectly into Section 5, the strategic horizon. Despite those modeled risks in Asia we just talked about, HSBC's core identity is deeply, deeply tied to the East. Recently, there have been some rumblings and concerns regarding non-cash valuation adjustments, basically write-offs on paper related to HSBC's investment in the Bank of Communications, or BOCOM, in China. But Brendan Nelson addressed this head-on at the AGM, stating very clearly, "We remain strategically committed to mainland China and our valued partnership of BOCOM." He really emphasized that these are merely accounting fair value measurements, not actual cash losses, and that their dedication to their Asian markets remains totally resolute.
So what does this all mean? Let's bring it all together. First, that 18.7% return on tangible equity proves exceptional near-term strength. Second, their wealth division is just doing phenomenal work, literally turning deposits into active engaged investments. Third, management is absolutely not resting on their laurels here. They're pivoting hard to a $1.5 billion cost-cutting program focused on the UK and senior roles to guarantee long-term efficiency. And finally, even though they're mathematically modeling a 30% risk of severe economic shocks in the US and Asia, they are standing firmly by their strategic commitments in mainland China and beyond.
Which brings us to the ultimate question as we wrap up this explainer. They've just printed a 20-year high for profitability. But with those external macro uncertainties looming so heavily over the US and Asian markets, and a highly complex $1.5 billion internal restructuring just getting underway at the head office, can HSBC actually maintain this record-breaking momentum all the way through 2026? It is an incredibly delicate balancing act of internal efficiency versus external global pressure, and you know it's going to be fascinating to watch it unfold. Thank you so much for joining me on this deep dive into HSBC's Q1 results, and we will catch you on the next explainer.